We're joined by Keki Mistry, who is the VC and MD of HDFC. Thank you so much, Mr. Mistry, for taking the time. Let me start by asking about your initial reactions to this 25 basis point hike. This was largely expected, but what are the implications on what are the lateral impact that you see on interest rates?
See, it is exactly in line with what was expected. If you had taken a survey of people yesterday, most people would have told you that a 25 basis points increase in the Fed rate is something which is imminent and bound to happen. Question was whether there will be a further 6 hikes after that or 7 hikes after that, whether it would be a 25 basis points increase or a 50 basis points increase. So I think Fed has made the whole roadmap extremely clear. The first rate hike is 25 basis points. There will be a further 6 hikes in interest rates, presumably of another 25 basis points, which means that we will close the year with interest rates which will be in the range of 1.75 to 1.9% in the US. And then this would probably be followed, in my view, by 3 additional rate hikes in the course of next year, which means that we are looking at the interest rates settling at somewhere in the 2.5-4% range in the year ahead, not this year, but the end of next year. But obviously, all this is dependent on inflation. All this is dependent on oil prices. But the good part of the Fed policy is that Fed was extremely confident, extremely buoyant about the strong economic growth in the US, which is what has given so much confidence to investors that the growth is absolutely on track. And Fed believes that even by increasing interest rates, it's not going to impact the growth.
Turning attention back to the housing finance companies here in India, what is the outlook like? A short while back when we've spoken to you, you've spoken about the huge potential that is available right now, that demand is booming in the realty space. Could you give us a sense of where things stand right now? How does it look on the ground?
All right. So if we look at the individual housing demand, the period from 2017, I would say the latter part of 2017 going up to 2020 was relatively a muted period for the real estate market in the metros. When I say talk of metros, I mean places like Mumbai, Delhi, Bangalore, and so on and so forth. But the tier 2 and the tier 3 towns continued to show strong growth even in that 2017 to 2020 period. Then came COVID. And as a result of a variety of factors, we started seeing a pickup in demand in the metros from, I would say, the second half of 2020. And that demand, which started in mid-2020, has continued unabated till the time we speak today. So it has been extremely strong growth. There was a slight lull during the second wave of COVID, which was in April, May of 2021, but a very slight impact, not significant. And the third wave of COVID did not have any impact worth talking about. The growth momentum is strong for a variety of reasons. One is affordability for housing has improved so much over the last 3 or 4 years, because from 2017 to 2020, property prices in the metros did not rise, but income levels kept rising. And therefore, the cost of a house as a multiple of the annual income of a customer kept declining. So affordability improved, and that created that spurred demand.
Good morning, Mr. Mistry. This is Cheryl also joining in the conversation. Could you shed some light on the demand matrix with regards to affordable housing versus high-end properties? And also along with that, if you could help us with your outlook on loan book growth in H2 FY22.
First, let me come to the second part of the question. We never talk of numbers on how the growth will be, but obviously if there is buoyancy in the market, the growth numbers also should be reasonably healthy. As far as affordable and the high-end market is concerned, as I said, from 2017 till 2020, it was the middle-income housing, the tier 2, tier 3 towns which were driving the growth. Today, the growth is coming not just from the tier 2, tier 3 cities, but equally so from the metros. So this is reflected in our average loan amount. Our average loan for new loans, this is average size of new loans we've given to individuals last year was about 27 lakh rupees. And this year, the average stands at 32.3 lakh rupees. So clearly, an increase in average loan amount reflects the pickup in demand in the metros, where obviously property prices are high.
Right, the demand is looking like there's a pickup in the demand in the metros, but yes, no doubt the prices are definitely high. That brings me to my next question, Mr. Mistry. What's the asset quality trends that you're actually witnessing, both in individual as well as in the non-individual loans? And is it safe for us now to say that the worst is behind?
I would certainly say that the worst is behind us. I'm extremely confident in saying that the worst is behind us. Month after month, by us, the entire banking sector has seen an improvement in collection efficiency. So there was an impact on collection during the first and second wave of COVID. But once COVID, and I must compliment RBI, I think they did a phenomenal job right through this COVID period, bringing interest rates down, ensuring that every segment of the market had access to money, making sure that borrowers did not face difficulty, permitting restructuring of loans, and doing so many things which helped the middle income people to come out of the COVID situation. So I think the bounce back has been so strong. We see that reflected in collections, as I said, not just for us, but for the entire banking sector. As far as individual non-performing loans are concerned, first you must understand that when you talk of non-performing loans, it's just a situation where someone has not paid installments for 3 months. It does not mean that the loan is at risk. It does not mean that that the borrower, that you'll have to write off a loan or you'll have a loss on that loan or anything of that sort, because the underlying security of the loan is always very strong. Also, for someone like us, we carry extremely strong levels of provisioning. So with improvement in collection efficiency, obviously, logically, month after month, we should start seeing NPL levels decline from the existing levels, which at least for individuals has always been very low.
Mr. Mistry, also trying to get a sense of the overall real estate picture. We tend to focus a lot on the metro cities, but could you also give us a sense of what is happening in the tier 2 cities, and what are the pockets of strength that you're witnessing in the real estate market?
Well, I would say the growth is coming from all over the place. But if I was to look at the metros, the growth is coming from Delhi, it's coming from Mumbai, it's coming from Bangalore, it's coming from Hyderabad, it's coming from Pune. So it's coming from all Jaipur and so many of the cities. And as far as the tier 2, tier 3 towns are concerned, there also the growth is coming by and large across the country. So it's north, west, south contributing largely to the growth. East historically has been a little slow.
Thank you so much, Mr. Mistry, for joining us on this leg of Buy Now, Sell Now to talk more about the home loan environment as well as what the Fed rate hike would actually mean for other emerging markets as well. That was Mr. Keki Mistry of HDFC. And on that note, we slip into a break.